All right, the time is now 2 minutes past the hour, and that's all the leeway we're going to offer late covers. We will just start with some housekeeping though, just to give you a bit of a sense of what we're going to go. We've got content, we think, for somewhere between 40 and 45 minutes. Most of it will be data driven. So, rather than kind of getting you all here just so we can watch the and give you our own opinions, we're going to try and be insight driven as far as possible. If you do have questions along the way, please do pop those into the chat box. That's the chat box, not Q&A, because some people can't access the Q&A depending on the software you've got access to. So pop your questions into the chat box and we'll get through them towards the end of the session. We are leaving about 15 to 20 minutes for questions, so lots of time for back and forth there. Okay, with that said, hello and welcome. Good morning. Thank you for taking the time today to join the webinar. Our subject today is the state of the climate transition for UK mortgage lenders in 2024. As some of you may well be aware, Kamma recently conducted a large-scale piece of analysis looking at the current climate transition plans of every single UK mortgage lender that we could look at. So around 85 in total. We're here today to do a couple of things. First of all, talk you through the insights, look at where the industry's ahead or behind, where we're performing better or worse, and to uncover which lenders scored most effectively, but also perhaps more importantly, pull together some best practices from across the industry. So what can we learn from those which are striding ahead? What can we do as organizations to catch up and collectively drive greater progress towards net zero? On that basis, I'm delighted to be joined by Amy Thomson, Head of Climate Risk and Disclosures at Nationwide. Amy is a woman who probably needs no introduction. She kind of leads by reputation. She's spent a large amount of time with the PCAF working group and wrote a large number of their guidelines. And she's here today to talk us through Nationwide's performance. They were the number one this year spot on our league table across 85 lenders. And she'll be sharing some insights around what has helped them to get to that position and what's coming next. So on that basis, we'll jump in. I'm aware there's lots of new people on this webinar that might not have heard of Kamma, so forgive me if this is self-indulgent, but just very quickly introduce us as a company. We are a geospatial technology company. That means we use mapping tech. And the reason we need to use this fairly high-end technology is because mapping, because property data is so very backwards. So we use this technology to identify a property, not just in one data set, but in multiple data sets, and collectively across these different sources of data, form a really rich profile of that property from an environmental and energy perspective. But then with this large-scale data set, we build different solutions and analytical approaches on top, which support a wide variety of stakeholders within the built environment. So this can be government, so we work with the Climate Change Committee. They have the carbon budget when it comes to residential property will be informed by this data set. As you can see here, we also work with a range of different lenders within the industry. We don't put these logos up to show off. I think most people you work with in the industry will have some clients they can talk around. It's more so that you know that we are tried and tested. So the kind of insights we bring to bear are those which are, to some extent, already industry currency. What am I going to get through before we get into the case study? We're going to go through the findings of the study. Now, this study was in two stages. The first stage was a meta-analysis of lender climate transition plans. So we sent a team of analysts across the web to source and assess and interrogate as far as possible the published information of UK mortgage lenders. What that means ultimately is we're able to look at 5 different areas and uncover. Can you see what I can see? Is it not working?
Just dropped out.
I think we've got a loose wire. All right. I have to say, I really enjoy the timing of me talking about how great our technology is, just as my monitor fails. Give me a moment. All right, I think we're back up. Excellent. Okay. Um, so luckily, the tech we produce that services property data is a bit more advanced than the tech I'm using today. Let's get back to it. So in terms of our meta-analysis of 85 lender climate transition plans, we're looking specifically at 5 different areas here. The first thing we're looking at is the strength of the plan. So looking for clarity and robustness of approach. We also looked at measurements, so how far lenders were disclosing their emissions, how accurate those emissions were as quantified by PCAF. We're looking at their targets, so were they setting robust targets, and were they specifically for the mortgage portfolio or downstream scope 3 emissions rather than everything else? Before looking at any actions that are taking place and then the progress of those actions. And note that you can see beneath each of those points how we scored them. So up to 10 points available per section. We obviously offered more points for those reporting strong progress, but it wasn't the only thing we looked at. This is partly because as a nascent area, as a new area of focus, it's not all really about end result at this point in time. It's also about kind of quality of process to get there, such that ultimately, as we do get into the later years, we will see more progress from those greater actions. So trying to be balanced in that scoring process. We then issued a survey, which we saw responses from 22 of the 80 organizations we asked to respond to us. And we looked at things like, how do people feel about their transition plans? We're trying to add the attitudinal layer to the quantitative data that we'd already collected. How do they feel about the priority status given to it internally? How confident they were in their plan? How far they thought they would be able to deliver against their climate targets and the impact they were having so far. So a good combination of kind of quantitative methods coming through. Why did we do this? I think we could maybe start with why we're not doing this. We didn't do this so we could kind of point a finger at certain organizations and say, you're moving too slowly. The main aim really is to understand, first of all, are we prepared for the climate transition? We've got physical risks, we've got transition risks. The transition themselves are hard to quantify because governments keep changing their minds. So we wanted to understand how far the industry is progressing anyway and compare across different lenders. We want to look at how they're measuring, managing, and mitigating particular risks. So again, looking at both physical and transition. We also want to understand how far they were able to kind of support their customers decarbonize. We've seen a dramatic growth in green heating products over the last few years. Are they cutting through? But perhaps more importantly, we really wanted to uncover what was best practice. If we take the best things that every lender is doing, or the best things in each area of each lender, what would the market look like if we're able to deliver those standards consistently across every single organization? And by doing this kind of quite simple analysis, we're able to deliver those back to the industry wholesale. Okay. So let's get into the breakdown then. How does performance compare across all these different sections that we've just introduced? So the first section we looked at was around planning, and how far the industry has been able to deliver robust climate plans. This is something which is perhaps no surprise to many of you, but the industry so far has been almost wildly inconsistent with how they're approaching transition planning. So 4 out of 10 are not reporting at all. Of those that are, just over a quarter have it as a subset in their annual report. Around a fifth have a standalone report, and then the top 10% are doing a bit better. So 5% have a transition planning task force aligned plan. 5% have a lot of those principles in their plan, but it's not necessarily fully aligned. So 10% delivering closer to best practice than the rest. I think our take on this is that this, to some extent, comes down to lack of clarity. So in terms of the expectations and the rules here. So if there are a clear set of guidelines on how to write a transition plan, I think as organizations would follow them. If there aren't clear guidelines and they aren't going to be enforced perhaps, then it comes down to a best efforts basis, and those efforts are going to be quite different. So as an industry, I do feel that based on insights like this, we urgently need to agree on what best practice is and all follow that. Not only would it lead to high quality plans, it would also help us in attempts like this to compare apples for apples, which we can't always do. Looking at our next section out of 5 was around measurement. And here we can start to see one of the key themes coming through, which is lack of data is really holding the industry back. The chart here shows us the proportion of lenders that are disclosing each of the following. So 30% talked about using PCAF to better measure emissions, 26% published their absolute emissions, 24% published financed emissions, a similar number published their source of data, and so on down through this list. So again, to some extent, we're seeing the same inconsistency, but in no case are we seeing huge numbers of lenders adopting what we would consider to be best practice, which in this instance means a PCAF score of 3.5 or below, which means a limited reliance on modeling. 3.5 was also the average PCAF score that we saw when we looked across every lender's disclosures. Also, importantly, we saw a lack of accounting for missing EPCs. So typically, you've probably heard these stats before, but around half the country doesn't have an active EPC. For lenders, we normally get a slightly higher level. If you're a specialist lender, you might have 70 to 80% coverage of EPCs, but you're still missing 1 in 5, perhaps. If you're a high street lender, that number's normally a little bit lower, so normally around 60%. We have seen some later life lenders, now bearing in mind their customers have no trigger to get an EPC, their coverage is about 30 to 35%. So in order to get a proper, thorough review of their back book, they need to find some strong way of modeling those missing EPCs to give themselves a better sense, not just of where they are today, but where they might get to in future as regulations start to bite. So in terms of measurement, lack of data and a kind of a data gap in existence, which needs to be closed. We did see this recognized as well in the survey. So we asked people, which elements of your transition plan do you think need to be improved? And the number one answer that we got back was data quality. Now, obviously, again, this is early stages. We've got lots of things we can improve on. Lots of things came through, from realistic targets to emission reduction planning, to financial emissions calculations. But data quality was the number one reason so far. In a separate question, we asked what actions are you planned to support emission reductions in the next 12 months? And again, improving data quality came through as the number one answer there. Now, when I talked this through with Amy as one of our kind of briefing sessions before the webinar took place, she offered a really good challenge to that point, which was quite frustrating because it was so accurate. She said, how does improving data quality help you to reduce emissions? Now think about it. If you better educate your customers, they go away and make some retrofit improvements, that reduces emissions. If you launch new green products, which finances improvements, that can reduce emissions. If you lobby government and they come up with stronger regulations, that ultimately will reduce emissions. But how does improving data quality actually deliver that same outcome? And therefore, how is that a valid answer to this question? It took me a while to think about it, but I have gone away and I do have a short response to that challenge, which goes a little bit like this. First of all, without accurate data, you can't get an accurate read on your emissions, and therefore you have no clear view of your starting point. We've seen some situations where lenders are overestimating their emissions by up to 40% because there's no quality control applied to a lot of the data. And sometimes EPC assessors confuse tons with kilos and dramatically inflate the emissions of a property. Also, the carbon intensity factors that are being used are from 2012 when the methodology was created. We've seen dramatic decarbonisation in national grid since then, which need to be reflected. These are the two major factors which cause to kind of a dramatic overstatement and prevent lenders having a clear view on today's performance, or a robust baseline that allows them to plan reductions in future. So we think there's a planning point, first of all. Secondly, we do think that the inaccuracy of the data leads to incorrectly priced risk and inefficient lending decisions. In other words, if you are missing data for some properties, if you can't actually get a really thorough understanding of the level of transition risk applied to a property, you may choose not to lend on it when in actual fact the risk is lower than you expected, or the flood risk perhaps does exist. Ultimately, you can end up with more bad loans or fewer good loans than you really want. So better lending leads to a stronger, more robust back book and a lender in a stronger position to further support decarbonisation. A lack of understanding of dependency. This is a point we'll come on to later, but ultimately it's very hard to set a target without understanding all the different major influences on your back book emissions. Without that clarity, not only is your target to some extent a finger in the air, but also you can't track the impact of these different variables such to give you a thorough and more sensible review point on a year-by-year basis. And then lastly, in answer to this challenge, something we've talked about before, but if you give your customers poor data on the ROI of retrofit, because it's from 2012, you end up overstating costs, understating return on investment, offering inaccurate recommendations, and in all these situations, you lead to fewer customer retrofits rather than more. So perhaps the biggest issue with poor data quality is that if it gets to the customer and they're given an overpriced view of how to retrofit, they're less likely rather than more likely to go ahead and retrofit. So 4 ways in which improving data quality can actually help you get a better sense of how to reduce emissions. Let's go back to our stages. Stage number 3 is on target setting. So we're assessing here the strength of the targets that our lenders are set, all 85 of them. So around a fifth have set a target for reducing absolute emissions. Similarly, a fifth have aligned with the Science-Based Target Initiative. 17% have set them around scope 3 emissions intensity, which we feel is slightly stronger because it's more comparable rather than just total. We talked briefly about those dependencies. A quarter recognize them as important, but only 7% have them quantified. Let's look into that issue a little bit in a little bit more detail, because I've mentioned them a couple of times now without really explaining what they are. Some of the work we've done for different lenders looks at the major impacts out there. This includes government policy, so it could be the heating and building strategy, for example. It includes the pace of decarbonisation of the national grid, which apparently is now going to be decarbonised by 2030 rather than 2035, so a key ingredient. It includes the rate of retrofit, so how quickly homes are being improved. And also includes things like the Future Home Standard. So if all new homes are built to a net zero standard, that starts taking place from next year when it's due to launch. And the house building targets of 300,000 new homes are built per year. What we're ultimately going to see is a number of properties equivalent to 1% of UK housing stock entering the market every year between now and 2030, which will ultimately improve the average, which should trickle into lender backbooks. So these are four key dependencies we can look at a macro level to see how far will a backbook decarbonize by 2030. Ultimately, unless you do this, you're missing a large part of the impact you're going to see on your backbook. So this is an example output run for a client of ours. We model things in different scenarios. So we look at what happens if things stay as they are. That's scenario A. We look at what happens if the government hits its targets and delivers against its policies. That's scenario B. And that gives you at least two scenarios of what might happen in the future, so you can set some targets around this. Now, this particular lender we work with is climate positive. They believe in the current government's policies and their strength of commitment. And so they set their target reduction as 50% by 2030. In other words, they're saying to the market, we've mapped these dependencies. We know that 41% of them needs to happen outside this organization. We can't control these factors, but the remaining 9% are the ones we're going to try and influence, and that's what we'll be building some policies and some products around going forwards. Another great example comes from Nationwide, who not only map these factors, but also indicate their level of control over each. We think that works very well as a lobbying vehicle. So rather than being told constantly by government, you should do more as a lender, you should be pushing up more products, doing more green loans, supporting more customers, you can push back and say, okay, we can do our bit, but these are the things we need to see from you as well that we can't control in order to hit this target which you've set for the industry. So a few different reasons why we like the approach of mapping out dependencies. All right, section 4 was around actions and what actions have been taken on lender transition plans. Here you can see the numbers start to drop off slightly. 15% had clear actions for reducing the mortgage impact, which went beyond simple retrofit. 21% were deploying some form of retrofit education. And note that here we're being quite broad. So some lenders have tools, they have techniques, they have whole eco hubs. Others have a bit of information on how to reduce your energy bills hidden away somewhere. So we covered off all of those. Around a fifth are doing something in that area. 19% have retrofit financing. So again, using one perhaps to link to the other, but only 1% could report that action plan was in progress. Now, if you think about the reporting cycles here, we're in 2024, we're assessing plans published in 2023, and those plans themselves can only assess actions from 2022. So to some extent, if you're looking at actions in progress, ultimately you're looking at actions which took place between 21 and 22. So perhaps that's why we're seeing a smaller number here. But ultimately, we're offering more points. We want to see more lenders moving to left to right on this chart. One thing we think could make a real difference, in fact, one thing the industry thinks will make a real difference, is the emergence of new regulations and the increase of climate risk and awareness of climate risk within the wider business. So we asked people what are the key drivers for creating a transition plan, and those two came out as top. So almost 80% talking about new regulations, almost 70% talking about climate risk as a business concern. Kind of pleasingly as well, 6 out of 10 talked about doing the right thing. Half talked about preparing the business for a low carbon economy. Interestingly, very few reported pressure from investors and even fewer reported pressure from consumers. Now, we do some work on the capital markets side, and we do know that the investor requirements are inconsistent. So there's some industry regulations or what should be reported on, say, an RMBS transaction. There are some investors which demand more information. Now, typically, it's driven by their own ESG strategy. They'll have promised their upstream investors they're going to invest a certain amount into green assets, and therefore they want to quantify that what they're investing in contains a portion of green assets amongst the wider pool. This last point, however, 30% saying there's not professional consumers, is perhaps more concerning. Even if some investors are talking about the need to provide more information, consumers themselves are ultimately where we need to see the traction. We can create all the products we need to, we can drive demand in a number of ways. Unless consumers respond to it, it's always going to be hard for us to hit our targets. We'll come on to that section around consumer needs and how to support or better drive consumer uptake. But let's return to those top two reasons, in particular, that top one looking at the rise of new regulations. So from 2025, this is the first year in which regulations will be ISSB led. This means that we will broadly still be in line with TCFD, but there are some increasing expectations. And across a whole range of different things, we've pulled out two for you to think about. So firstly, Scope 3 emissions reporting is recommended at the moment under TCFD. It will now be mandated. 24% of lenders, as we saw earlier, are currently disclosing. That will need to be a lot higher now because every business over 500 employees or 500 million in turnover will be mandated to report on those emissions to the city. And then similarly, they're asking us to disclose how transition risk is measured, managed, mitigated, how these organizations have to talk to investors about how you are stress testing your exposure across different scenarios. We haven't seen any stress testing when it comes to things like the minimum energy efficiency standards, which if they increase to C, will lead to an investment requirement of around 29 billion into the private rented sector. So a big challenge to the sector, not one that we're currently talking about in transition plans, but one in which we expect to be mandated from next year's report onwards. And finally, let's look at progress. So ultimately, we haven't seen a huge amount of reporting progress. We talked about this a couple of slides before. 90% are showing some progress against targets, 6% are supporting the retrofit planning. Only 3% can show a significant reductions in Scope 3 financed emissions on a year-on-year basis. Now, we define significant in line with the CCC's pathway for residential property as a decrease of 7.5% or more, which we only saw from a couple of lenders, including Ecology, which we think are obviously taking this because that's their whole reason to be as a business, and they're potentially making decisions to not invest in browner stock in order to support this reduction. We think it's hard to do that through a pure play kind of retrofit support strategy. Thinking about this with a more positive note, though, if this did happen across all the lenders in the market, if we were able to achieve a 7.5% reduction in emissions, we would be a much, much greener industry. So around 1 in 4 UK properties have a mortgage. So that's probably around 20 million tons of CO2 per year. A 7.5% reduction means we're reducing by 1.7 million tons. So taking some strong steps towards it. So again, going back to this point around why we release this analysis, we're trying to deliver more consistency. If we can deliver consistency here, we are going to be moving a lot faster. So reason to kind of take note and offer some food for thought there. What's slowing us down? We're returning to this issue around consumer demand. So we ask people, how confident are you? Or how do you feel your green lending provision has performed compared to your expectations? So not compared to the market, not compared to targets, but compared to how you thought it was going to do. We offered them a 5-point scale. So 5 was higher than expected, 1 was lower than expected, and absolutely no one chose to use the top of that scale. So for half the market, the proposition is doing as they expected, but for the other half, it's performing slightly worse than they thought it was going to do, which gives some sense of where the holdup is, if you like. It's perhaps not with these forward-thinking lenders who are pushing propositions out there. It's with consumer demand not quite keeping up with it. We've got a few points on to say about that. First of all, just because we're not finding the exact right proposition today doesn't mean we're not going to not find it tomorrow. There's an interesting point of view which combines both Eastern philosophies and also Western kind of startup and tech thinking, which is that trying is doing, testing and learning is the right way to get towards the truth. And if you look at the gap between the average score for each of our 5 sections compared to the average score for the top 10 lenders, the biggest gap is in this area around actions. So you'd expect gaps everywhere, right? They're the top 10 lenders for a reason. They're going to outperform the rest of the market at every stage. But the biggest gap was where it came to actions more than anything else. So in other words, the best lenders in the market right now are those that are testing and learning and innovating, and finding things which may work in the future, finding better propositions, better ways to speak to their consumers in a way that drives more action. On the supply side, or demand side, sorry, once we dealt with the supply side, the question is, are we in sync with our customer demands? Do our propositions speak to the emotive drivers of behavior, which as a marketer, we can talk about how that yields greater results than functional and physical benefits alone. So we asked people, what's the top barriers for your customers? Why they're not retrofitting more? We came back with low awareness of benefits, lack of knowledge, cost, and then 4 and 5, low awareness of financing and retrofit being too invasive. When you speak to customers, it's all about cost. So the number one reason why it's too expensive, too concerned about the cost and the impact of that on their monthly budgets, especially in a cost of living crisis. So no surprises there. What we feel as an organization is there is opportunity there to better help customers understand the exact ROI and the exact impact of retrofit. We've done some math internally where you look at some properties in the UK, perhaps those that don't have an insulated cavity, so there are kind of quick wins available for those properties. But for a large portion of UK housing stock, you can improve them cheaply enough that the cost of a loan to improve is actually offset to a large extent by the fuel savings on the retrofit approach. So we did some scenario testing. I think we found one proposition through Santander, which was a very generous green loan. We didn't use nationwide because we thought it'd be cheating. It's 0%. But on kind of an actual loan, which is actually making money for the organization, we found that the actual cost of retrofit loaned out through this financial vehicle versus the cost of energy savings led to an overall net spend of £15 per month for 5 years, followed by 15 years of net benefits of about £145. So a material saving over time and not a huge investment in the short term either. We think those are the sorts of propositions and angles which, taken with consumers, could make more of a dent in this great need to retrofit. So in summary, let's try and build some key themes from this. I promised Amy I'd finished at 11:30, so I'm almost there. First of all, standardization is key. Let's go back to our first slide. We think we need to see what best practices across the industry and do a better job of delivering against that consistently rather than taking unique and subjective approaches. Number 2, data quality is a priority. We hope we've given you a few reasons why it is worth prioritizing, as we discussed. Number 3, think now about IFRS S2 and the increased regulations and what that might mean for how you look at things like transition risk. And we do talk sometimes about this notion of a transition risk paradox. Thanks to CBES and NGFS scenarios, we've got a clear view of how to think about physical risk and flood risk in particular on the back book. We haven't got a clear playbook or a clear set of regulations for how to stress test exposure to transition risk. And yet transition risk will happen over a much shorter time frame. It's going to impact by 2030 in the case of MEES, rather than say 2050 and beyond when it comes to flood scenarios. And then lastly, something that we've seen almost regardless of the lender we're looking at is that decarbonization is not easy. So we do believe in testing and learning and iterating to find the best possible proposition, which when unified with increased pressure from other organizations, including government, including other stakeholders within built environment, we do think will start to move the needle in terms of levels of retrofit in this country. There is just one slide here talking a little bit more about Kamma, so please do indulge me. What we offer our clients is ultimately an out-of-the-box, best-in-class set of climate data. So whether it's the most accurate available view on your financed emissions, proper stress testing, looking at the true cost to see or a more accurate estimate of cost to see versus value, a clear view on those dependencies we talked about earlier, or a better and more accurate conversation with customers, we've got the data to support you. So if you do want to learn any more about that, please get in touch with me directly. But for now, we're going to hand you over to the lender who within our league table managed to top it. That is Nationwide. So over to you, Amy.
Thanks, Joe. I'm conscious there's a lot of content that you went through there, so I've no doubt everyone's got loads of questions. So I won't take up too much time in order to get there. I'm also conscious that I've had a little look at who's on this webinar. There's lots of very familiar names, so it might be that some of this content you will have heard before in terms of roundtables and participation across the working group. So I'll sort of go through it quite reasonably pacey, but hopefully there's some interesting nuggets in here. The first thing I thought I'd just sort of anchor us on is you're probably very familiar with Nationwide as a building society, but we do have a incredibly strong purpose. And effectively our purpose is to be fairer and more rewarding and for the good of society. We have a number of sort of commitments that sort of underpin our purpose, including our commitment to a net zero future and our commitment to building a more sustainable world by supporting the progress towards a greener society. So particularly that's centralised on UK housing. And we are effectively aiming to support the UK in achieving its net zero ambitions by 2050. So part of that, and I'll move on to the next slide if it's okay, Joe, because effectively what we've done is we signed up to the Net Zero Banking Alliance back in 2021, and as part of that process, as some of you will well know, we are required to set a series of targets across our business model within an 18-month window, and then subsequently publish a transition plan. So we achieved both of these milestones. So back in December 2022, we published our set of targets, and that's across our entire business model, across scope 1, scope 2, and scope 3, on both the upstream and the downstream lending book. So the targets are shown on the screen. Importantly, I guess what we did when we set our targets is we didn't just publish a set of numbers, we also published effectively quite a lengthy narrative-based disclosure outlining some of the challenges that we will face in order to meet those targets. So we've been very, very clear from the word go around the level of control that we have as a business in the achievability of those targets and the level of influence that we will have. So we're very clear that scope 1, scope 2, purchase electricity, purchase gas for use within our buildings, fully within our control. And we have quite a lot of confidence in achieving those targets in advance of the 2030 deadline. Equally on the upstream side, we've set a target to reduce emissions. So some of our peers will have set similar targets, others will have set like an SBT engagement-based target. But ultimately we have a partial level of control in this space because whilst we don't necessarily control what our suppliers do in terms of transitioning towards net zero, we can obviously control our spend, who we spend it with. So we have a level of control and influence in that space particularly. However, probably the most interesting area is the downstream portfolios, particularly mortgages, our registered social landlord portfolio, which is our housing associations, and also our commercial real estate, which in the bulk is real estate. And we're very clear that we have very limited control. And a lot of the actions that we have to play with are out of our control. So in December 2023, we published our transition plan. And our transition plan is a really good step change on from our targets. And on the next slide, it just sort of indicates some of the kind of the themes that we sort of considered. So we aligned ourselves to the transition plan task force guidance. Helpfully around the same time as setting our transition plan, we also we're in development of the banking guidance specifically, and I sat on that working group. So that was a really helpful tool. There's a lot of materials that the transition plan task force have out there. So if anyone is sort of in the earlier stages in their planning, definitely look up all of those tools and absorb their guidance. There may be elements of the guidance that you don't want or you don't feel comfortable necessarily meeting right now, but I think that's good. I think ultimately this is about starting the process and getting yourself off the starting blocks in terms of transition planning. The Glasgow Financial Alliance for Net Zero also has very similar and very aligned guidance to the Transition Plan Task Force. In fact, they're pretty much the same. And broadly, our transition plan, which if you haven't had a look at it, is structured and aligned to our business model and the way we talk to our targets. But the themes of the TPT and the GFANS guidance runs through our transition plan. So absolutely align it to what you believe is the right thing for your business, effectively. So our transition plan goes into, as Joe mentioned, a lot of actions and detail around the actions, both within and outside of our control. We've also done a lot of work and a lot of modelling to estimate the impacts of those actions on the ability to reduce emissions in line with our plan. So, and that includes both on the scope 1, 2, 3 side, but particularly on the mortgages space, where we have effectively a developed internal model which predicts some of the expected outcomes of UK policy activities. So do take a look, because a lot of our narrative that we talk to both in our plan and also in our climate-related disclosures, which we publish on an annual basis, hangs off the narrative that underpins our transition plan. In terms of kind of some of the actions and the things that we've done, first thing to talk about is probably some of the greening of our own business operations. So our business operations, scope 1, 2 emissions, we've done a lot of work to reduce in line with our targets. They're fully in our control. And we've done a lot of work to remove the gas from our branch network. So over 80% of the gas used within our branch network has now been replaced with electrical solutions. And we continue to source 100% renewable electricity and have done since 2018 through both green tariffs and also the use of a purchase power agreement based, so basically leveraging a solar farm in the UK. And interestingly, because of the confidence and I guess the control levels within scope 1 and 2 particularly, we've chosen to align those to directors' long-term remuneration. So there's lots of kind of considerations around the impact of our targets and our ability to achieve that linked to remuneration packages for the nationwide. The second thing, which I'll briefly touch on because I've actually got a little bit more detail on another slide, is around green finance propositions. So particularly leaning into the mortgages space. As Joe mentioned, we've got a pretty market-leading green additional borrowing product out there, which I'm sure you're all very familiar with, because in June we reduced it to 0%. And alongside the 0%, we've also released a white label product with a home energy efficiency tool, which sort of helps identify some of the potential measures that consumers may want to make in their homes in order to help green them. The third thing is around our supply chain activity. So this is where we have partial levels of control, and the team at Nationwide has done a huge amount of work in supporting our suppliers, building in requirements within third-party code of practices, as well as encouraging those to sign up to a platform called EcoVadis, which is like a sustainability data platform for suppliers to encourage the setting of targets and to encourage the setting and releasing of disclosure information in relation to sustainability. And we've also introduced 10% minimum weighting within our tenders. So there's lots of activities that we're doing to try and encourage suppliers to make the right choices effectively within their businesses. And then finally, by no means least, and it's probably the key thing really, if anything, is the influencing. So we have what's called a Green Homes Action Group. We've been running it now for a few years. It's a cross-industry group across not only lenders, but across kind of the building industry as a whole. And it's a really important tool that we have in our toolkit to help campaign and influence policymakers. So we've been very consistent in our messaging around some of the requirements that we would like to see from policy in order to encourage the greening of homes. And we believe our voice is a really powerful tool in that regard. And that's where our transition plan really helps. So to Joe's point earlier in the webinar, having something in a plan allows you to then talk to it and gives you a voice at the table. So even if you don't think it's 100% perfect and you've got all of your actions nailed, actually having something there to leverage with those key policymakers, I think is a really important and useful step for you as a business to have a voice in this topic. And then the final slide just goes into a little bit more detail about our propositions. So I just wanted to mention that we've been on a journey. It's not like we've sort of only been doing this for a year or so. We've been trying and testing various different approaches to the greening of UK homes for a number of years now. So the first thing we did was launch an additional borrowing mortgage, and our additional borrowing mortgage, we've been on the market now for a number of years. And we also launched effectively a switch partnership. So we've been trying to encourage those through those types of products to effectively retrofit their homes, make green home improvements. And then in 2021, we launched what's called a green reward. So it's a cash incentivized mortgage for those who are potentially buying slightly more energy efficiency homes from the beginning. So those in the sort of a high B EPC A range homes. And then we've also launched separately for our the mortgage works, so our buy-to-let lending portfolios, similar products to support them in terms of greening their homes. 2022 saw a bit of a step change for us because I know some will be familiar on the call, but we ran a solar panel pilot, and that was with an arm of the Switched partnership through an incentive called Make My House Green. And what we were aiming to test there was our ability to, I guess, lend trust and our brand presence into the retrofitting market. And we know we're not retrofit specialists, so that's very much Make My House Green's role in this. But it was whether to test whether or not, as a financial service provider with a relatively large brand presence, whether or not we can add value into that market. And we've also done a number of social housing sustainability linked loan propositions. So we're supporting our social housing, and we are also building our own EPC rated homes in Swindon on a brownfield site in Swindon called Oakfield. And we're hoping to test that as a bit of a blueprint to creating sustainable homes in the UK. And then finally, as I mentioned before, we reduced in June of last year our green additional borrowing mortgage product to 0%. I think we're the only ones in the market at the moment who are doing that, in terms of trying to incentivize and encourage consumers who are considering retrofitting improvements to make those sooner rather than later. We've seen a reasonably good uptake in terms of if you compare the data in our disclosures from when it was a rated product to when it's a 0% rated product, there is definitely an uptick in terms of interest and in terms of completion rates for that product. However, it is still not at a huge pace. So at the moment, we've got around a 5,000 customer pilot, and it's probably about a third of the way there. In terms of the volumes that we're seeing. We were hoping, I think, secretly that it would be a fly off the wall type proposition, but it just shows that the barrier to entry for retrofit isn't just in the finance space. There's that awareness piece, that education piece, and that policy piece that sort of sits alongside it that needs to be put in place in order to make the most of some of these great propositions, because we know they're out, the only ones in the market offering amazing green finance opportunities to consumers. So we know that it's a really good way of trying to kind of influence. And as mentioned in our disclosure this year, we're doing a piece of research on this particular product, and we're hoping to release a research paper on it, which again will help with that influencing piece, particularly on the policymaker side. So please do watch out for that, and it'd be really interesting to get your views once that lands on whether you're seeing any kind of similar themes in your organisations. But yeah, that's all I was going to talk about. I'm conscious that we've got 15 minutes left, so I think I'm to time there, Joe. Hand back to you.
Bang on. Thank you very much, Amy. And a wonderful depiction of the impact that testing and learning, taking different approaches can deliver in terms of delivering a stronger transition plan and a stronger basis for the future. So that's it for the official content. We can now hand over to formal questions.
Joe, I know you can't see the Q&A, but there are a couple in the Q&A. Would you like me to read? So this one actually is for you. It says, is it fair to say that unless we have the clarity from the government in respect to who is paying for a retrofit, customers will be reluctant to improve their properties?
It's a great question, and I think we have to obviously nod towards the timing of this webinar. So the Labour Party's conference is in Liverpool right now. I woke up to some headlines this morning in trade press talking about Labour being at war with landlords and demanding they improve the energy efficiency of their housing stock. To link to this question, one issue we've seen there is that we have different products which actually support landlords in other areas. One issue we've seen from that group is a lot of those landlords, because they're aware of the spend cap, there's mooted to be a £10,000 spend cap on energy efficiency improvements to get their homes to a city. They don't want to start yet because the money they invest now won't count towards it. So if they go and spend, £2,000 on insulation now, and then the policy comes into force next year, they've got to spend £10,000 more. So in some sense, there's a lack of government clarity around who's doing what and when, and that is slowing things down. There's also issues in terms of the speed of rollout. So Eco4 and the Great British Insulation Scheme, the latter being the government's attempts to widen the scope of qualification and go after quick wins, even if the occupiers of that property are not as say low income as those who qualify for Eco4, both of which are moving very slowly, not because of a lack of clarity around who's paying, but because of lack of awareness of these schemes and the fact that when tradespeople knock on their doors and saying we can give you free retrofits, it's not believable to people. So they actually spend a lot of money, these guys, the retrofit suppliers that we work with, spend a lot of money trying to find people in order to offer them free improvements. So what those two different examples hopefully articulate is that yes, there is a lack of clarity around policy, and that does muddy the water and prevent people taking action in some instances, but it's certainly not the only problem. I think there's a wider issue around total awareness, both of the challenge to hit with the climate crisis, but also with the energy crisis, and then what is available in terms of grants. Some of the eco rules are very complex. It's very hard to work out who qualifies and who doesn't, and that also slows us down. So what we feel as an organization is we can't just rely on one piece of legislation. We do talk, and I'm guilty of this probably more than anybody else, is of going on and on about the minimum energy efficiency standards. That's only one piece of legislation. We need a whole kind of a whole patchwork of policy, which impacts different parts of the built environment to get us moving at the kind of pace we need to hit our interim and ultimately our net zero targets.
There's another question in the Q&A, Joe.
Okay.
I think it's for
I thought
me.
I'd be interviewing you, Amy,
Yeah,
but
I know.
like this role reversal.
Role reverse. For adapting, it's great. The question is around how Nationwide overcame the challenges of bringing senior leaders on the journey of setting targets from the start, because they're very hard to achieve. Yeah, I'll answer that. So yeah, it was a really interesting journey that we went on, and it was a journey that we started around the time we signed up for the Net Zero Banking Alliance, and that was one of the conversations that we had very, very early doors when we signed up to the alliance, and we went in very eyes open. So we knew that it would be a hugely challenging target. And we even had early stage conversations with our CEO at the time, even had a conversation with Mark Carney, who was the UN ambassador for that at the time, and said, these are the challenges. But I think at the time, there was still a lot of expectations from investors and the like that you should still be trying to set targets and trying to achieve goals, even if you know that they're not achievable. So it's better to be in the pack and have that goal out there to, I guess, comes back to the influencing point, be able to have a voice, be able to bring your voice to the table and be in the conversation than it would be if you chose not to do something. And part of the reason why when we set targets, we didn't just set a set of numbers. We could have just published a set of numbers. We published an entire disclosure, which went into quite a lot of depth into control and influence, was for that exact reason, was to help our senior leaders get over the challenge that we are effectively going out there with targets that we know we're not really going to be able to achieve. So that was in part of the reason why we were so open and transparent and have been continuously. So that really helped in terms of that engagement.
Yeah, I'd like to nod towards one of the organizations we work with, Atom Bank, as well, because they're led by the execo on this, and we've seen firsthand the impact that can have in terms of the depth of engagement they then get. So it's definitely a worthy aim. It's very hard to get anything done without buy-in at senior levels, and across any category really. When it comes to trying to talk to people about the need to kind of do more around the kind of broad area of the climate crisis. Most people focus on the moral reasons, and the impacts to lives, to livelihoods, etc. And that's one angle. Perhaps cynically, we find we get greater impact when we focus on the financial angles. So if you talk about climate risk, you talk about new regulations, new reporting requirements, you talk about like hidden climate risk because the data's not there and it's not actually defined as to what climate risk is going to be yet. And the need therefore to stress test and look at different scenarios and do far more in this area. Much in the same way, if you tell people they can save the planet by improving their home, they might do something, but you can tell them they can save money, they'll do even more. Taking that same approach with internal teams can also support action, motivation and buy-in.
There's a couple more questions, Joe. One's definitely more in your space. I will throw it to you. That's all right. How are the best lenders modeling the macro impacts? For example, changing demand isn't an easy abatement model without smart meter data. I know we've had a similar conversation about smart meter data.
Yeah, so we're in this rare situation of being not particularly pro smart meter data as an organization. It's partly because our work with government, the government data when it's released, they have to provide both emissions data, but also kind of weather neutralized emissions data. Because if it's a particularly warm year, people are less inclined to put the heating on, and therefore the smart meter data doesn't actually tell you what's happened in terms of decarbonization. It just tells you that the temperatures are higher that year. So there's a range of different data sources we need to model into it. There's also a point around whether or not a lender is responsible for personal behavior, which I think is a step beyond what we've seen so far. You can argue if you're funding a property, then you are to some extent responsible for the emissions of that property, but not potentially for the person who goes and lives there. So ultimately, the more data you get, the more accurate you can be. There's no data that's perfect. It's about finding as many sources as possible and providing the best analytics for your business as possible. And even then, data doesn't guarantee you'll be right. It just reduces the probability that you'll be wrong. So probably too much nuance to give an easy answer to that question.
No worries. There's a question here which actually, I mean, it does say it's for the group, and actually it's probably more for kind of everyone on this call to have a think about, but it's what can we do better to educate consumers and improve awareness?
It's a great question, especially when we've seen so little traction, or not as much as we wanted to see in terms of traction anyway, more broadly. We've been doing a lot of research. Some of it we funded, some of it's been sponsored through government grants, and etc., around the choice architecture and what we can do to better motivate people. One of the key findings of that is that we ultimately keep scaring people off by showing them these are all the things you could do to a home, and the price point is £25,000. There's very few homeowners today who have that size of a bank balance or willing to take on that size of loan to go ahead and make green improvements. We've had much greater success of saying to people, stagger the improvements, set a budget per year, and think about, first of all, what are the quick wins? Changing light bulbs, draft proofing, heating controls, which will pay for themselves in year one. Do that to begin with. And once you've got that almost case study and validation for green improvements, think about insulation. If you've got brick wall and there's no cavity, it's going to be far more expensive. So potentially draft proofing is about as far as budgets will stretch. If you have any cavity walls out there, they're really easy to fill in. They'll offer good value, good return on those investments. Same with roof insulation, for example, as opposed to floor. And then you've got a position to look at the larger systemic improvements, whether that's solar or heat pumps or anything else. So trying to stagger things and talking about people rather than what's the maximum retrofit package, what's the optimum retrofit package, and how can you do things to match up to their budgets rather than telling everyone that's going to be a hugely expensive exercise.
Really useful. There's one here actually, and I know that we've been grappling with this a little bit as well, is around EPC inaccuracies. Are we perhaps giving mixed messages by saying we need to achieve EPCA when this currently can be achieved with a gas boiler? We know replacing gas with low carbon heating is ultimately the solution to decarbonise the housing stock.
Yeah, so do you want to start on that one, Amy? We've got a camera point of view, but we've talked about so much. Okay, so EPC, there's problems we can improve and problems we can't. Ultimately, anything which is kind of the more objective end, so things like estimated energy savings or estimated cost or emissions, we can improve those outputs by getting better sources of data. The one thing we can't mess with is the methodology, because EPC is still the language of government. It's still the language in which regulation is written. The target's still set around EPC ratings. And so we have to leave it alone and report on this is the current EPC rating of the property. And therefore, partly because we can't do anything about it, we do have those same frustrations. The problem that the question alluded to is that the EPC process assumes the sources of electricity are much dirtier. So it's the most common method used to assess property in this country is SAP 2012. That's the methodology which has been used for about 95% of EPC certificates that are available in this country. Like the name suggests, all the data, it's not dynamic and improving or changing over time. It's static, and it's based in 2012. The national grid was much dirty in 2012. And therefore, if you switch to an electrical source of heat, whether that's a heat pump or anything else, you get punished in the SAP ratings. So in some cases, you switch from an efficient boiler to a heat pump, you could end up with a worse EPC rating or fewer start points because it assumes you've switched to a dirtier source of fuel rather than a cleaner one. There is various different lobbying efforts going on behind the scenes. The methodology does need to change, and that's something which I think different organizations are looking at. There is something coming out potentially next year called the home energy model, which is meant to be much more fit for purpose, avoiding some of those challenges and linked to much more accurate data.
Yeah, I would agree with all of that. I think we know that EPC is a cost-based measure at the moment, and it is not a net zero aligned carbon-based measure. And I think that's part of the challenge. And the home energy model will hopefully correct for that. Although I don't believe they are doing a back book. So I think it will be very much a kind of a considerate point for firms when that model comes out. Yeah, it's a really interesting point, and one that we need to consider. But to Joe's point, it's sort of the language of government. So you sort of need to tread it probably quite carefully. And then there's one more here, Joe, on understanding how you can model EPCs to potentially better improve PCAF scores.
Yes, that's an interesting question. So there's a number of things you can do on the modeling side. At Kamma, we've seen some fairly shocking attempts to model missing EPC ratings. Anecdotally, we've heard of lenders being told that 15% of their back book is EPC grade A, when only 0.3% of the entirety of the country is at a grade A. We've also looked at data where we've been able to look at the model that a previous supplier has offered on a kind of a postcode average basis. We saw that in a few disclosures, actually. I think it's fairly common to use a postcode average if you haven't got the EPC. We looked at EPC's ratings that had been assessed and uploaded since that modeling exercise, and that approach was 49% accurate, which is closing on the kind of the broken clock twice a day sort of level. What we found internally is that there's no perfect methodology for every property in this country. So you can look at machine learning approaches where you're modeling various sources of data from different places to try and replicate that EPC rating. You can look at a geospatial or lookalike model where you're mapping out from where that property is based to assess similar properties and similar EPCs in a similar area. If you bear in mind that different parts of this country are built at different times, they're built to the similar standards. We found the best way to get the best possible match in terms of EPC rating and also for emissions is to mix those methods. So look at the type of property. If it's homogeneous, if it's a flat, for example, there's a number of flats in that building, or it's part of a single state development, use a geospatial lookalike approach. If it's more heterogeneous, then the machine learning approach is more successful. Ultimately, you can get close to 4 out of 5 properties right using that approach. So a much better level of accuracy than 1 out of 2. The issue with that is that PCAF will still punish you for it. So at the moment, if you don't disclose, I think it might come down to how it's actually being rated and enforced, but a lot of lenders are choosing not to disclose their missing EPCs at all. They're kind of assuming there's this big data gap, and PCAF's rewarding them for it because there's no kind of punishment in terms of points. So you can find yourself producing some kind of accurately modeled certificates, but ending up with a worse PCAF score. But ultimately, what you're doing is closing a data gap, which otherwise could come back to bite you, because as climate risk grows, the cost of not knowing potentially increases. So we think it's still worth doing.
There's no more questions, and
excellent. It's perfectly timed then. It's 11:59, just under 12. Okay, well, thank you so much, Amy, for joining us. It was an absolute pleasure, and I really enjoyed getting a better sense of all those things that Nationwide have done over the last few years to drive towards your leadership position in transition planning. And thanks to everyone for joining as well. We know there's probably about 1,000 webinars you could join at the same time, especially in Q4. So thank you very much for joining. And please do get in touch with any questions or any outstanding things you want to discuss. Thanks again, everyone. Have very good afternoons.